Good morning, everyone. I thank Economic Times for inviting me today to express my thoughts on the topic Reviving India, the power of collaboration for change. The Indian economy is coming out of the second wave of the pandemic, and the atmosphere is one of cautious optimism. India's active case flow has declined to less than 7 lakh after 11 weeks. Also, less than 50,000 new cases have been reported for the first time after 3 months. The impact of the first wave is now clear. The GDP loss was to the tune of 7.3% in the financial year 21. Among all this, the silver lining is the double-digit growth recorded in the gross fixed capital formation aided by the government's push to infrastructure. But the private participation in the investment has been lackluster on account of uncertainties. RBI estimates real GDP growth at around 9.5% in 21-22. SBI's Wages Activity Index is witnessing a smart traction in June. Interestingly, rural economy seems to have recouped faster than the devastating impact in April and May. The question now is of sustainability of such recovery going forward. With good monsoon forecast this year, the rural demand is expected to remain strong, which will anchor the overall growth outlook. The worrying aspect of the pandemic has been the spurt in inflation. CPI inflation for May was 6.3%. It has increased by about 2.1% over and above April 21. International commodity prices have risen substantially on account of ample liquidity, production disruptions, and weather-related events. Shipping cost continues to spiral. The Baltic Dry Index has surged to its highest level in more than a decade. As supply disruption coincides with the bounce back in demand, further pressure on prices are likely. Going forward, the economic outlook, though, is still positive. The recent Sero study suggests that third wave may not be as severe as it was talked about. India's merchandise exports continued on the robust growth in May 21, growing by more than 50% on a YOY basis, partly on account of the low base. Non-oil exports have exhibited positive momentum for the 9th consecutive month. The major sectors that have grown includes engineering goods, petroleum products, iron ore, and drugs, and pharmaceuticals. Labor-intensive sectors such as cotton, textile have also moved to green. With US economy doing well, external demand is favorably poised for the financial year 22. Coming to the banking system, banks have adjusted well, as reflected in largely good results reported in financial year 21. On a year-on-year basis, non-food bank credit growth stood at about 5% in March 21 as compared to 6.7% in March 20. Credit to medium industries registered a robust growth of about 28% in March 21 as compared to the contraction of 0.7% a year ago. Credit growth to micro and small industries decelerated to 0.5% in March 21, reflecting the sluggish trickle-down effect of policy initiatives so far. In the first 2 months of this year, banking business is slowly returning to pre-COVID levels and is expected to continue in this direction after a very promising budget that is focused on infrastructure creation and demand revival, and the recent announcement to front-load the capital expenditure. Though there could be some concerns on the banking front because of the lockdown, a couple of points needs to be borne in mind. It is essentially relating to that the banks have been consistently reducing NPA levels just prior to COVID-19 lockdown. Second, with RBI restricting the dividend distribution, internal accruals from the regular profits and the treasury income also complemented banks' capital augmentation plan, and the capital infusion of 20,000 crore by the government will also come very handy in augmenting the capital base of the banks. Further, with the creation of an ARC, there is an additional comfort that NPA issues will be addressed on wider scale as against the individual bank level efforts. But the key question is how to bring growth back on track amid rising commodity prices. Revival of growth now requires deeper appreciation of the new complex situation. The imperative of growth revival have to acknowledge that consumption alone cannot deliver required results unless and until the income level also improves, which in turn requires a predominantly investment-led growth going forward. Recognizing this, Honorable Finance Minister in her recently announced budget speech pitched for a front loading of capital expenditure proposed in the Union Budget 21-22. Front loading of the budgetary expenditure and CPSP capex appears to be the government's great initiative to salvage the situation in the short run. RBI also has echoed similar views that investment-led recovery is more sustainable and can also lift the consumption in parts by better job creation. For the present, RBI has refrained from any further change in interest rates. At the same time, policy actions have become more focused to keep the market interest rates at a reasonable level, thus preventing hardening of the spreads in the corporate bond market. The central bank has also taken several sector-specific measures to cushion the impact of the second wave. RBI operationalized an on-tap liquidity window of 50,000 crore with tenors up to 3 years at the repo rate till March 31st, 22 to boost liquidity for ramping up COVID-related healthcare infrastructure services in the country. A separate liquidity window of 15,000 crore with tenors up to 3 years at the repo rate till March 31st, 22 for certain contact-intensive sectors, that is hotels, restaurants, tourism, travel agent, tour operators and adventure heritage facilities, aviation ancillary services, etc. I think that will go a long way in terms of providing succor to the ailing sectors. In respect of MSMEs, pre-packaged insolvency measures will have tide over the stress caused by the pandemic, together with enhancing the aggregate exposure threshold from rupees 25 crore to 50 crore. Among other measures, the emergency credit line guarantee scheme is already operationalized and has been expanded in scope considerably. Banks have so far sanctioned 2.5 lakh crore worth of facilities and have room to disburse another 45,000 crore worth of loans under the ECGLS plan. In the current crisis, banks have played a pivotal role. The Atmanirbhar Bharat package announced last year places banks as central to cushioning the impact of COVID-19 pandemic. The cost of credit has also moderated sharply since then. SBI has launched 3 new products under Atmanirbhar Bharat schemes with Agri-Infrastructure Fund, Animal Husbandry Infrastructure Development Fund, and PM Formalization of Micro Food Processing Enterprise to bolster the investment credit portfolio in the agri segment. We have completely revamped and simplified our SME lending procedures, keeping in mind the customer's convenience, and have introduced technology-based digital offering and process improvements. Our SME Gold Loan product is one of the most competitive in the market today. Another aspect of pandemic that needs attention is the rapid adoption of technology among the public. The share of digital transactions and alternate channels has seen sharp rise in the banks. Journey towards less cash continued during the year with a rapid growth in digital payments observed with the gradual relaxation in lockdown imposed due to COVID-19. At an aggregate level, the payment system recorded a robust growth of 26.2% in terms of volume during 2020-21, on the top of the expansion of 44.2% in the previous year. The substantial cost saving due to digitization that are not visible now will become apparent if investment-led growth path is chalked out. Before the pandemic, corporate strategy was driven in large part by the quest for operational efficiency. After COVID-19, operational risk will play a much bigger role in corporate planning. Real-time cash management, end-to-end supply chain, and vendor financing using digital platforms are being recognized as key to operational efficiency and containing risk. Besides this, the bank needs to diversify risk to look out for the sunrise sectors while supporting those which have the potential to bounce back. Startup, renewables, logistics, value chains, and other such potential areas are some of the key such focus areas. Thus, a complete relook at the business strategy and orientation by using innovative use of technology is the immediate need of the hour, for which active collaboration is needed. Additionally, healthcare is a sector which is getting major policy support, mirroring the resolve of the government towards an all-out war in our fight against the pandemic and provide opportunities for growth. Accordingly, 3 new products have been designed to provide fresh lending support to vaccine manufacturers, hospital, dispensaries, pathology lab, manufacturers and suppliers of oxygen, ventilators, importers of vaccine and COVID-related drugs, logistic firms, and patients. And also we have started offering some support to the patients for the treatment as well. The first one is the healthcare business loan for setting up oxygen plant under ECLGS schemes for existing hospitals. The second is a direct business loan to all stakeholders of the ecosystem engaged in building and serving healthcare infrastructure. The third product is an unsecured personal loan for COVID treatment. At State Bank of India, we stay committed to the vision towards a healthier and resilient India, having launched our unsecured personal loan scheme Kavach for the needy customers. Vaccination remains the key towards building herd immunity and to restore normalcy. India administered a record 86 lakh vaccine doses in a single day. This is the highest ever single day vaccination achieved in the world so far. To conclude, as far as banks are concerned, being an intermediary sector, we have high forward linkage, implying that we depend on demand for other sectors for our business. Despite 3 rounds of stimulus, the utilization of sanction limit is only in the range of 60 to 70%. Therefore, there is also an element of risk aversion, which has an impacted growth as far as the trade and commerce is concerned. It is thus imperative that industry uses this opportunity and also avail the benefits of the PLI scheme and take the initiative to relocate international supply chains to India. As banks, we are committed to look at new sectors as opportunity for diversification. I thank all the audience for a very patient listening. Thank you.